You're watching Kitco News. I'm Michelle Makori. Inflation surged in June at its fastest pace in nearly 13 years. CPI increasing 5.4% from a year earlier. And producer prices are up 7.3%. That is the fastest acceleration on record. Well, who better to discuss this with than renowned investor Dr. Mark Mobius? He's the best-selling author of several books, including The Inflation Myth and the Wonderful World of Deflation. And Dr. Mobius is, of course, best known as the founder of the emerging markets asset class and is currently the co-founder of Mobius Capital Partners. Mark, thank you so much for joining us.
Well, thank you very much, Michelle, for having me. I appreciate it very much.
All right, Mark, I definitely want to discuss your outlook on emerging markets, but I want to start with the US, where inflation is very much a hot topic these days. Now, your most recent book, The Inflation Myth, an excellent read, by the way, well, essentially says that we can't really rely on or trust government measures on inflation or cost of living as accurate gauges. But nonetheless, when we get this kind of CPI and PPI data, what does that signal to you?
Well, first of all, it signals that the people are looking at the wrong number because, as I point out in my book, the CPI, Consumer Price Index, that's normally used to measure so-called inflation, is very, very inaccurate. It doesn't take into account a lot of expenditures by people who don't want to reveal what they're spending. And also, it's based on a basket of products and services which are changing, so that you're comparing apples and oranges. You say, okay, this year the number was this, but 3 years ago it was another basket, and it's a completely illogical way of measuring inflation. But what I try to point out in my book is that the so-called inflation, or the rise in prices of goods and services, is based on the currency devaluation. Because all currencies, again, I pointed out in the book, throughout history have never kept their value because governments keep on printing. And that's what's happening in the United States and Canada and other places around the world. In fact, M2 in America this year is up 20%. So logically, you would expect that the demand for goods and services will result in a higher and higher price in currency terms. But then again, as I point out in my book, balancing out against that is the incredible innovation that's taking place with all kinds of technology. So, for example, when I was going to school in Boston, Massachusetts, MIT, many years ago, admittedly, but I had to spend maybe $20 or $30 to make a 1-minute call from Boston to New York. Right. Now I can do it for nothing. That is technology. And that means you have the two forces. You have one, the devaluation of the currencies because of currency printing, and then the technology fighting against the increase in goods and services prices. And that is a very interesting dynamic that we're experiencing right now. But I must tell people that if you're looking at true inflation, you have to look at the devaluation of the currency.
So, Mark, would you then say that the devaluation of the currency, and we'll talk about the US dollar here, is in fact at a higher level or worse than the CPI data would indicate, if you think that CPI is not an accurate gauge of inflation or devaluation of the dollar? What is that true level then?
That's right. In other words, what I'm saying is that, okay, the CPI may say, oh, it's up by 1% or 2%. But actually, the devaluation of the currency is taking place 20% because of the increase in money supply. But as I again point out, against that is the technological innovations that are coming in to help us fight against these increases in goods and services. Nevertheless, you will see prices of gold, silver, properties rise because of the devaluation of the currency.
All right, so Mark, you're saying that we can't actually see this as an accurate reflection of the true health of the economy. So what do you regard to be the true health of the US economy now when you balance out the dollar devaluation as well as the tremendous leaps in technology?
It's a very interesting question. We really should, instead of having a CPI, Consumer Price Index, we should really have a index of happiness. In other words, how are people getting along in their daily lives? Do they feel happier? Are things more convenient? Is it more easy for their life? That's the kind of thing we have to look at. Unfortunately, they're not very good measures now have been invented to measure happiness. You can get people's opinion and so forth. But at the end of the day, what I try to tell people is that look at the money supply, look at how much more money is being printed, and you can then rely on that to determine the value of money going forward. So keeping that in mind, when you're saving, you've got to put your saving in commodities or in services products, which will keep pace with the devaluation of the currency. This is the reason why many of us investors advise people to put money into equities, into stocks, into companies, because companies adjust their prices in line with the devaluation of the currency. And they will then continue to hold the value of the money that you put into their shares. Gold, silver, palladium, platinum, these are other alternatives. If done on a dollar cost averaging basis, should do fairly well. But to look at the CPI as a measure of what's really happening is a big, big mistake. And that's the reason, one of the reasons why I wrote the book is that I noticed central banks keep looking at this number, and it's a very erroneous number on which to base earth-shaking decisions that affect millions and millions of people.
All right, so if measures of inflation are fundamentally flawed, and let's assume that they are, and we'll hone in on that more in a bit, but it still doesn't address how investors should be dealing with devaluing money. How should investors be looking at the role of what the Fed calls inflation in their portfolios at the moment?
Well, the first thing they should do is ignore the inflation number as not being accurate and a true reflection of what is happening. More importantly, look at the money supply growth as a measure of how that money will eventually be devalued. One thing people have to keep in mind is that throughout history, no currency has kept its value. None. There's no currency in the history of the world that's kept its value. And the US is in the same position. By the way, I'm now reading an interesting book about Cecil B. DeMille. I don't know if you remember the name. Cecil B. DeMille was one of the big movie producers in Hollywood for many, many years. He did Samson and Delilah, the Ten Commandments, and so forth. And I am reading in the 1930s, they were doing a movie, full movie for $100,000.
Wow.
10 years later, it was $1 million. Today, what is it, 20, 30 million? The film has not changed, but the costs have gone up dramatically because of the devaluation of the currency. So that's something that people have to really keep in mind to protect their wealth.
Okay, well, what about traditional safe haven assets against a devaluation of currencies, against inflation like gold? What is your outlook on gold?
My outlook on gold long term is that it will hold its value, and it will increase in dollar terms, in currency terms, whatever currency you want to use, as we go forward. So there's no question that gold is a very good haven to save assets. But unfortunately, with gold, it doesn't pay dividends. But good company stocks, companies that have a high return on capital invested, the companies that have low debt, these are the companies that will really keep pace with the devaluation of the currency. And that's where people should be parking a significant amount of their money, in addition, of course, to their home. Their home, a place where you live without a mortgage, that's the first order of business before you do anything else.
How would you allocate your portfolio accordingly then, as a personal investor, to the asset classes that you mentioned?
Well, it depends on how much money you have, of course.
Right.
If you're on a salary and you have very little savings in the bank, then the first order of business is get a home. Buy a home, buy an apartment where you can live. And that will retain its value. In fact, may even go up in value. That's the first order. The second order of business is to then, if you have extra money, is start investing in stocks, good company stocks. The third order of business would be to have some money parked in gold or one of the precious metals, whether it be palladium, platinum, or silver, but gold is probably the best alternative. And by the way, by that I mean not gold stocks, but physical gold.
Physical gold, like 5%, 10%?
I think of 5 to 10%, yeah, that area.
All right, well, Mark, you may not be focused on the CPI numbers and the PPI numbers, but Fed Chair Jerome Powell is. For the most part, he's dismissing this as temporary, says that the economy is, quote, still a ways off from levels that the Fed is going to need to see before tapering its monetary support. But what happens when that does happen, when the tapering does begin? Do you expect a taper tantrum, if you will?
Yeah, of course, if it depending on the speed of the tapering. They actually are doing a little bit of tapering in any case, but if it's done rapidly and suddenly, then you can have a real tantrum and you can have the markets affected dramatically, because people will then be looking for the finance if it's not there. You know, the money will not be available. So I think you're going to see when that happens, of course, the cryptocurrencies will be hit badly, and that will affect the psychology of many, many people, particularly young people who invested a lot of money in cryptocurrencies. And then, of course, then you'll see a decline in the stock market. That will be there.
You think the first asset class, if you will, to take a hit from the Fed tapering is cryptocurrencies, that is where the first domino is going to fall?
I think so. Yeah, I think so, because in order for these cryptocurrencies to maintain their value, they need more inputs of money. In other words, you've got to have more people coming in and believing that these cryptocurrencies will go up in value. Of course, you have the same thing with the stock market, but cryptocurrencies is particularly vulnerable to a shortage of cash, of extra cash. By the way, when we're talking about crypto and even the market, it's a lot of the increases in these prices is due to extra cash, another excess cash that people have. For example, in the United States, as you know, a lot of people have been getting a check in the mail for $2,000 from the government. What do they do with that? They're not expecting it. So then they go out and put it into the market or put it in crypto or take some gamble, whatever. That kind of thing will stop when the money spigot closes.
So you're saying that there are areas that are particularly frothy at the moment. Which ones do you see, or which sectors in the stock market do you see as being more vulnerable to an asset bubble pop or deflation, if you will?
Well, I would say, generally speaking, the tech area, and here I'm talking about tech companies who are not earning any money, no earnings, but are being propped up by hope, by people who hope that there will be another Amazon or there'll be another Apple or whatever. There are many, many companies like that are going for IPOs, that have been listed and not making any money. These will probably be hit the first and are vulnerable.
All right. Well, as you say, a lot of this stems from those unemployment benefits, a lot of fiscal stimulus as well as monetary stimulus flooding the U.S. economy under the Biden administration, which many are saying is, in fact, going to lead to the long-term debasement of the U.S. dollar. Do you agree with that general sentiment?
Yes, I think that's true. But I must also mention interest rates. You must remember that the Fed and banks around the world have pushed interest rates down to even negative levels. In Europe, it's negative. You put your money in the bank, you have to pay the bank to keep your money. In that kind of environment, as soon as you see a shortage of money and a rise in interest rates, it can be real devastating for many companies that are highly leveraged, which is why I keep on telling people don't get into companies that have leverage, because As soon as those interest rates go up, they're going to be in big trouble. And one of the big risks that we face.
All right, so if you agree that the dollar is at risk of debasement, what does that mean for emerging markets holding US dollars and having dollar debt? And also, what does it mean for those emerging markets when and if the Fed does eventually start to raise interest rates?
Well, the emerging markets have the same situation because many of these emerging markets have also been printing. The good news is that many of these emerging markets have not taken on US dollar debt. Because if you remember during the big crisis that we had in Asia, that was when these countries were borrowing in US dollars. And of course, they were not able to print US dollars. So they had to then convert their local currency into US dollars. And of course, the market was going against them. The currencies were being devalued, and then they got into big trouble. So it depends on the degree to which they have US dollar debt and also the degree to which they've been printing in their own country the currencies. The good news is that many of these emerging market countries have had a strengthening of their currencies. You take Taiwan, Korea, even China. As you know, the renminbi has gotten stronger against the US dollar. But the bottom line is that when you have debt, when a country has debt, it better be in its own currency. Because, there's another myth book called the deficit myth, which proposes that a country that has a debt in their own currency doesn't have to worry about that. So the US government doesn't have to worry about that because they can print. If they have debt, US dollar debt, they just print, pay the other party. So that's another idea that's infiltrating into the minds of people in Washington. And it'll be interesting to see how that works out.
Well, before we focus more on emerging markets, I do want to hone in on a few of the concepts that you mentioned in your book. And you make the argument that deflation is actually a positive. And that, in a way, is something that the Fed or the US economy should be focused on achieving. So expand on how you see deflation as a positive economic factor and why striving for inflation is, in fact, the wrong way to go about things.
That's a very, very important point, deflation, because as you know, if you mention deflation to any economist, or many of them, they'll shudder. They'll say, no, this is bad, this is evil, it should never happen, et cetera, et cetera. In fact, there's one theory, which, by the way, has been adopted by central bankers around the world, that you've got to have 2% inflation in order to see growth. They believe that a country cannot grow unless you have 2% inflation. So they try to promote inflation. Now, what I'm saying about deflation is that, why is it good? Deflation is good because goods and services are going down in price. And that's good for the consumer. It's good for the people that are consuming in a particular country. It's good for the society. I can't figure out any reason why lower and lower prices for goods and services should be a bad thing. It should be a good thing. By the way, particularly for the lower income people in the society.
Well, let's just break that down, because the counter argument to that in there too is that prices are deflating because of declining demand. That's one thing. And another argument is made that deflation is bad for growth because businesses then delay making purchases if they see that prices are going down in anticipation for further price declines. So it hampers further growth and further investment. So what do you say to those two anti-deflation arguments?
Yeah, those are the arguments that are used against deflation. They say, look, if people anticipate lower prices, they won't spend, they won't do anything. But the reality is that people have to spend, they have to live, they have to consume. Whether you're a housewife or whether you're a businessman or whatever, you have to consume, you have to eat, you have to sleep, you have to you like to entertain yourself and so forth. So the argument that people would not spend does not hold up because people want to live. The good news is that if you're consuming and you see prices getting lower and lower, you have to be buying more. You have to be spending more. So that could be very good for the society in terms of consumption. So I don't follow the argument that they're using that deflation is bad for the economy.
The wonderful world of deflation, as you say in your book, Mark.